Hi there, hope you're doing well today. I wanted to talk about something that I'm getting a lot of questions about from some of my clients, and that's related to interest rates. So the $1 million question in the marketplace right now is, where are interest rates going? Right now, interest rates are a little bit over 1% on a 10-year treasury bond. And if we look at where those rates were a year ago, that's a pretty big decline in interest rates. We know 2020, we know how that played out. The Federal Reserve cut rates. Federal Reserve took some pretty drastic action to inject liquidity into the marketplace by not only cutting rates, but by also buying U.S. government bonds and even some corporate bonds. So there's been a lot of action at the policy level, the federal government level, to dictate where interest rates are and to act as a little bit of a lid on those interest rates. But now we've moved into 2021. We have a new year. There are new concerns, new developments around the vaccine, around the path and the trajectory for the U.S. economy. And a lot of people are asking what does that mean for interest rates? Where are rates going to go? Because interest rates have a huge bearing on a lot of different parts of the economy. They have a huge bearing on borrowing costs for our country, on borrowing costs for consumers, just for individual Americans and for businesses. They have a huge impact on the stock market too, because whenever interest rates move up and investors, can invest in assets that have a higher yield, a higher cash return, things like fixed income investments or similar investments, then sometimes you'll see a rotation from more risky assets to less risky assets whenever interest rates are a little bit higher. Right now, with rates very, very low, it incentivizes people to go and buy riskier assets to try to seek some level of return. Because on bonds right now, there's just very little return to be had. The vast majority of the return expectation on a bond is from the interest rate, from the coupon that we get paid. And so when that rate is very, very low, it pushes a lot of investors to seek return elsewhere on assets that just have a higher risk profile. So, those are some of the reasons why people really want to know, where are interest rates going? Well, if I had a crystal ball sitting here on the table today, I would gaze into it and be able to tell you exactly what's going to happen. Obviously, I don't know. I don't know where interest rates are going, but some of the factors that could influence where interest rates go are the pace of the economic recovery as it continues to develop. As we see the economy recover and heal from the COVID lockdowns and the economic recession that we've gone through, you would expect to see, that recovery continue to play out in 2021. And the pace of that recovery and the impact that the economic recovery has on things like wages, on things like job hiring, on just the overall level of consumption in the United States, all of those things really work together. So if the economic activity in the U.S. continues to ramp up and continues to improve, if the stimulus efforts from the federal government, really from the congressional level to pass, more stimulus bills to inject more cash into the U.S. economy to provide more of a bridge for income purposes for those people who've really been negatively impacted because of the coronavirus. If all of that economic stimulus and fiscal stimulus from Congress, if that adds to our economic activity and to people's consumption, we could see wages go up. We could see some increases in prices. And those increases in the price of goods and services is usually reflected as inflation. We think of that as inflation. So if inflation moves up, what impact might that have on interest rates? Right now, we have a Federal Reserve that's kind of more or less acting as a lid on those interest rates, because right now the U.S. Treasury is issuing all of the new bonds to finance the stimulus efforts that Congress is coming out with. So Treasury issues the bonds, and the Federal Reserve is turning around and buying a lot of those bonds. And the Fed buying those bonds is acting as that lid. The big question is, will they continue to be able to do that? Will their bond buying efforts continue to be that lid on interest rates? Or if we see economic activity ramp up, if we see inflation starting to run, Would the Fed, be more or less forced to let those interest rates move up with the impact of the overall market, just the market's effect, and not necessarily the stock market, but just the economy itself? Would that force rates to go a little bit higher? If that happens, if rates go up, then potentially we could see some rotation in the stock market. We could see some of the things that have worked well in a very, very low interest rate environment, maybe not be the areas of the market that are the leaders in this next area, or in this next time period in the market. In a higher interest rate environment, you tend to see more cyclical stocks do well. Things like financials would probably benefit from seeing higher rates. And then, the fixed income areas of the market, would probably benefit in that people would on one hand want to go and potentially buy bonds as more bonds are being issued at higher coupons. People might want to go and buy those bonds and sell some of their stocks. The other impact, though, on the fixed income market is that for the bonds that are already issued, the bonds that are already out there in the marketplace, when interest rates go up, bond values tend to fall. There's an inverse relationship between bond values and overall interest rates. So we have to account for that, especially when we're looking at longer dated bonds, whenever we're looking at lower quality bonds. Interest rate risk is a real thing. It's something to account for. So we just want to be thinking about all of that as we're putting together a portfolio and making sure that we're managing the risk that exists there on the potential for higher interest rates. So certainly not a prediction from me today that we're going to see way higher interest rates. We're not predicting anything along those lines, but we need to account for the possibility that if rates go up, it's going to have an impact. There's going to be a little bit of shifting potentially in the marketplace, both on stocks and bonds, if we see rates go up. So if you're contemplating what that means for you, feel free to reach out to me and the team, and we would be glad to help out and have a conversation around how you should manage for interest rate risk. Thanks. Have a great day.